All right, seeing as we are the first presentation, let me welcome you all to the first presentation round of the CFA Challenge. We are from Bethel University. I am Kyle Arvilla. This is Jasmine Kirchner, Gabrielle Olson, Lucas Bunting, and Aaron Olson.
MTS Systems Corporation is a global supplier of test systems and position sensors. The company's objective is to support engineers in research, product development, and manufacturing. It produces a range of customizable hardware and software so engineers can simulate and measure forces and motions. MTS's executive management team is comprised of individuals in both engineering and business. This gives MTS insight into the company's ultimate customer. Executive compensation is based off of return on invested capital as a performance metric in order to promote long-term growth strategies and align management with shareholder interests. MTS operates in a number of different industries. This serves to diversify risk and level performance in the long run. Within the test segment, they primarily operate in the automotive, aerospace, wind energy, and infrastructure industries. And within the sensor segment, they operate in the industrial machinery, heavy equipment, and mobile hydraulics industries. Moving into some industry trends, the automotive industry makes up approximately 45% of the company's test orders. This industry has seen tremendous growth in recent years, particularly in the US and Asia. We're forecasting this trend will continue with a compounded annual growth rate of 4.71%. The aerospace industry also makes up a large portion of the company's test orders. MTS currently has 25% market share in this industry, and two of their notable clients are Airbus and Boeing. Both companies had high orders and backlogs in 2015. This industry has a growing global demand for fuel-efficient aircraft, particularly single-aisle planes. Thirdly, the industrial machinery industry also makes up a large portion of the company's sensor orders. As their customers have rebounded from the financial crisis, they're building smarter machines, which creates a demand for advanced sensors that MTS can fill in the marketplace.
We chose two particular graphs to show you competitor analysis, and we chose our four competitive groups, or the comparison of the peer group comes from the four publicly traded companies that are closest to MTS. The first is the price to earnings ratio. As you can see, MTS is overvalued both versus its own historical performance and versus its competitors, which will come into effect when we talk about valuation later on. Secondly, you can see that MTS's net margin is shrinking at a time when many of its competitors are growing, which is concerning for the company. We're going to look at Porter's 5 forces to understand how MTS fits into the overall industry that it participates in. So as you can see, there is low competitive rivalry, low threat of new entrants, and low threat of substitute products. What this means is that the industry in which MTS operates is a very mature industry full of companies that have very well-defined market niches. MTS is no different. MTS itself fits into the high-cost, high-quality, specialized orders segment. It does this very well and has a very dedicated customer base, and we don't anticipate this to change. They have a very well-established place in the market. So what we can see in competitive positioning is that its ratios, which we also have appendix slides on, are about average for the industry, and that it's overvalued relative to the others and has very, very well established. There are four primary macroeconomic things that we're looking at in terms of MTS that slightly worry us. The first is continued volatility in the global equity markets as commodities continue to plummet and investors show great uncertainty. This is a problem for MTS because MTS is so globalized that any effect on the global economy has an effect on MTS. And so we're going to watch volatility moving into the future. The same goes for global growth. As many of the markets mature, we see that MTS is going to be affected by slowing growth, particularly in terms of demand. Thirdly, we see that MTS has invested heavily into China, but China right now is highly volatile and appears to be slowing down, and the future of China is rather uncertain. This means that MTS's heavy investment into China in the future may not pay off. Furthermore, they get a lot of their orders from Europe, and with problems in the EU and the Eurozone currently, that may prove to be problematic for MTS. You can see from these graphs that China's GDP is growing and the United States and the Eurozones seem to be leveling off, which is problematic for MTS. And then the last graph shows the currency headwinds, or just the fact that the yuan and the euro are depreciating very heavily against the dollar, which is concerning since MTS does so much of their business in those zones.
MTS is composed of two operating segments, including tests and sensors. Tests was 82% of total sales revenue in 2015, and sensors made up 18%. We expect this mix to remain steady in the near future. Sensors, although smaller, has higher operating margins than test as depicted by this graph. And test is MTS's core business line and operates in 3 markets, including ground vehicles, materials, and structures. Sales revenue growth has been lackluster for test in recent years, which contributes to flatline growth overall. An increase in custom projects has pushed test operating margins down 4% over the past years. The company estimates it has an 8% share of a $1 billion market for servicing test products, which we see as a key opportunity for revenue growth, though it is limited by the time it takes to train these service engineers. Sensors operates in 3 markets, including industrial machinery, mobile hydraulics, and liquid level storage. Sensors is a more volatile source of revenue for MTS, and like test has been experiencing shrinking margins of 7% in the past 5 years.
There are several global trends we believe will increase future demand for test and sensor equipment. The ability for MTS to capitalize on these trends will be vital for their future growth. First of all, energy scarcity will force the energy sector to improve efficiency and invest more heavily in renewable resources. Environmental concerns will drive companies to seek alternative methods to produce their products, and the growing middle classes in many developing economies will drive testing and sensor equipment sales. In order to fuel inorganic growth, MTS will look to their acquisition strategy. Historically, MTS has been conservative yet active in this area. Based on their historical behavior and current financial position, we expect MTS will spend no more than $100 million in their next acquisition. Over the last 10 years, MTS has grown their top line sales at 3.5% annually, and their sales have a very high correlation with US GDP, making their overall sales very dependent on economic conditions. Profit margins for the company have been shrinking over the last 4 years. ROA and ROE have been significantly underperforming the company historical averages. MTS primarily attributes its poor profitability to currency effects and translations. However, we feel that increasing costs, a record backlog, and also their slowing inventory turnover are straining the profitability. Dividend growth has been flat in the last several years for the company, and we do not expect MTS to increase their dividend anytime soon, primarily because their profitability is struggling.
All right, so WACC. We use the CFAMN approach to calculate WACC. It's summarized in the middle of the screen. On the left half of the screen, we have the 4 main factors, and we came to a cost of capital of about 11.5%. On the next slide, we used a DCF with the aforementioned WACC and a 3.75% terminal growth rate to arrive at a per share equity value of $50. We also forecasted free cash flow out 5 years and then multiplied those values by the probability of occurrence, which we determined would follow a normal distribution based on back testing, and that per share equity value was $63. We also used secondary valuations to support our primary valuations. We used a PE premium in which MTS maintained a PE over ITW, their closest competitor. We used a price of free cash flow, price of sales model, and all of these results are summarized in the graph and table on the right. And they all support the notion that MTS was overpriced on December 31st. Our primary and secondary valuations weighted on breadth and depth of the model yields a 1-year price target of $58.57. And with a price on December 31st of $63.41, we recommend to sell not only because of price performance, but because we were convicted that MTS was overvalued on December 31st and better risk-adjusted return could have been achieved elsewhere.
We outlined 3 high-level risks for the company, first being their growing backlog, which was $353 million at the beginning of the year, second being their exposure to foreign exchange rate risk, and third being that their business is driven by their customers' appetite for research and development expenditure.
Overall, we believe that MTS is a well-managed company that has a well-established market niche, but we believe that it is too mature to continue growing organically, as you can see from their inability to execute on their backlog and their shrinking margins, even in times of increasing demand. Furthermore, our evaluation showed that MTS is overvalued relative to its competitors and to itself, and therefore we stand by a strong sell recommendation.
Thank you for your presentation and nice job. I've got a financial modeling question. You kind of had a fairly pessimistic outlook for global growth, global GDP growth. You also mentioned that MTS's operating margins have declined for 4 years in a row. But in your model income statement, you have sales growing about 4%, operating margins expanding about 200 basis points. I'm just wondering what the drivers are of that margin expansion in your forecast.
Yeah, so the main drivers, let me see if I can run back to the evaluation here. So the main drivers for this are actually somewhat relevant to what the main drivers for WAC were. They're not adding to their dividend, so we felt that that would help the growth somewhat. But also just the fact that their sales are tied to GDP, and we don't think GDP is going to be flat. We think that GDP is going to grow as forecast about 2%. And so because they have about a 0.85 correlation coefficient, we think that it will continue to grow. We just don't think it's going to outperform by any means. Okay? So sorry if we weren't clear on that, but that's what we're
Question, seeing as a lot of their revenues are achieved through ground vehicles, I think it's about 40% of the test, and we've seen a significant increase in auto sales since 2010 that have reached about pre-crisis levels. Do you see, maybe analyze, or not analyze, but just discuss, if we see sales plateau and also how that will affect the company and any possible remedies that they can address the situation?
So the automobile sales, we believe, are reaching a plateau, so they've been growing, but because of slowing global growth, we see slowing demand for automobiles. Furthermore, there are several competitors, which we even have in our competitive slide, or our peer group, that also operate in the automotive segment. So just because automotives may continue to perform well, that does not mean that MTS will outperform the competitors in that case. And then overall, when it gets to the bottom line, we just see that they might not even be able to execute on those increased orders if automobiles continue to.
They have similar exposure to their competitors as far as ground vehicles?
They have slightly more. We don't have a graph or data to back that up, but because of the nature of the industry, there are a lot that very highly specialize in specific industries. So there's some that have a lot of ground vehicles, there's some that have a lot in sensors, etc. And then MTS, it's reasonable to believe that there are other ones who would also be exposed.
Thank you.
Having studied the company, if you were to put on a consultant's hat with regard to their strategy, their financial structure, what would you advise management to do differently to create more opportunity for the company and for its shareholders?
kind of going back to the backlog that they have, right? So our main solution to that problem that we would think that we would recommend to management would be to expand. Buy a company that's similar to MTS that can expand their capacity utilization, because if they can act on that backlog even better, if they can get more of those sales pumping through, then we think they can grow sales that way.
I'll weigh in. One tool that the company is not currently using is using debt. So using more debt to finance acquisitions and other growth strategies would be something that we would advise management, definitely.
So you have a slide for management compensation, but you only made one comment about compensation. Can you talk about the changes in the management team over at MTS over time and how that has factored into your analysis?
So MTS has historically used engineers as their executive management. Jeffrey Oldenkamp joined the team in January 2015, and he has a very good financial expertise, and so really that will stimulate some of the using debt to finance projects. Along with that, they have an executive compensation plan that's set up to kind of match their peers. They use a core group of 24 companies. And then they also use return on invested capital as a metric rather than using time vested stock to incentivize long-term growth strategies.
Do you know what the targets are that their stock is tied to, the return on invested capital
I
targets?
do not know.
Thank you. I see you had a slide on there on the company's competitive positioning. You guys went through it pretty quickly. Could you just maybe spend a little bit more time and kind of go through how you guys would probably grade the company's competitive position? And I didn't see, did you incorporate that outlook on its competitive position into any of your evaluation framework?
Yeah, and specifically in one model, and we definitely beyond that, but if I can draw your attention back to that one model that I had just a couple seconds to touch on initially, we felt that ITW was their closest competitor. ITW is a lot bigger company, but they have similar products and similar exposures. And so what we did is we calculated their PE premium over ITW and what they have maintained. And so their historical premium has been about 1.53, and whereas their current premium on December 31st, was about 2, supporting that it was a bit overpriced.
And because of the nature of the industry and the nature of the company, MTS is involved in a lot of different sub-industries in the testing and sensor industry, and many of its competitors are not publicly traded. So there isn't one particular company. Like ITW was the closest competitor that we could find that competed on the most cylinders, but because of the difficulty of assessing, comparing peer-to-peer, we weighed that valuation model, or the peer comparison, lower than some of the other models that we ran for valuation, just simply because there isn't another company quite like MTS.
Another management question. When you went out to visit them on your analyst day, did you get a feel, or were you going to annual report maybe on company management's history and track record of building out growth targets and getting those milestones, or what their track record is in that?
Could you repeat the last part of the question, please?
Sure. I'm just wondering if you feel like management has a good track record of meeting up with financial targets, whether or not they get those milestones, or kind of overpromise and under-deliver track record.
We read over a lot of the all of the conference calls for the last 3 years, and it seems that they were always coming up with an excuse for just slightly missing, which is pretty par for the course for earnings calls, I understand. Our main concern was that they promised that they would be able to handle this backlog, and they said it in conference call after conference call after conference call while the backlog continued to grow, and they said that they were doing things to improve efficiency, but in the end we just don't see the results of that, and we don't anticipate that that is going to significantly come in the near future. But as far as growth targets go, they are pretty on point, very slight deviations from it, and they have reasonable explanations in the earnings calls. But like we said before, we still believe that you could find better risk-adjusted return elsewhere in the industry.
The market values a company today where the market views its future cash flows. If the market's incorrect, you think it would come from either revenue expectations being wrong, from margin opportunity, or from valuation the market just doesn't get what the company's worth.
I think we come through the perception that, or the position that the company it had been growing for a long time, and the market had followed that with its valuation and its assessment, but that was also going off of promises that management had made and anticipation of future growth. And we believe that the market just hadn't taken into consideration some of the volatility that we were going to be seeing. And so now it's correcting, as you can see with the price to earnings ratio. So it's just kind of an overheated position.
What were the reasons for the margin declines in the test business from 13, they were running at 13 to 15% between 2011 and 13, and then they dropped off to 9, and then sensors dropped to 19%. What were the reasons for that?
Well, one of the reasons, part of margins, is sales, and we have a case for the flat revenue that we've already talked about. And so we feel that it does actually originate more from costs.
Along with that, in your test segment, they've been taking on more custom projects. These are much more spending for the company to create, and so shifting focus from regular products to the custom products has boosted costs.
All right, thank you.